And I laid out what I call the Rails framework. So we talk about Bitcoin running on Bitcoin Rails. And I laid out the Rails framework. And I think about, a lot of Bitcoiners think that Bitcoin gets rid of financialization, right? So our entire economy has been financialized. Every asset's been securitized and financialized.
What are your thoughts on this? This is something that came up probably 2 months ago or so. We had a couple guys who were ex-Wall Street, 40 years plus on the floor, and they're pounding the floor on this. They're talking about paper Bitcoin. Everyone's lending, which is great. I prefer not to sell my Bitcoin. I've been stacking. I'm like, that's ideally my retirement bag. That's not something I prefer to trade. So in my head, at some point, lending has to happen in a way that's not going to screw me over. It's not going to be completely lended on top of, lends and we get screwed up here. But what are your thoughts on the whole world of lending? We've got everyone entering the game, it feels like, but there's only 21 million coins this time. It worked before with fiat. Can it work with Bitcoin? I just want to get some of your thoughts on paper Bitcoin. Do we have more than 21 million? And, I just want to get your thoughts on this.
Okay. So I would break those two subjects apart. So we can talk about paper Bitcoin and are there more than 21 million Bitcoin, but I don't know if that has anything to do with lending. So I think those are two separate conversations to have. So we can talk about the paper Bitcoin first, and then we'll jump into lending, which I think is a much bigger subject. So when I think about paper Bitcoin, we think about like paper gold, right? So you have physical gold. Obviously, you can have it in your safe or whatever. If I have the gold, it's physical. I have the gold. And if I give it to you, you have the gold. But then we put it on a ledger. And so now how do we know that ledger only records the one physical ounce of gold that's really there? And they don't really give both of us credit for the same physical ounce. And so that's the problem with the ledger. That's why gold failed. And we know in the gold industry, we have all these gold ETFs, and we know that there's way more gold owned than there are actual gold units for that. Now, it's gotten so out of control that we don't actually know how over levered it is. It's rumored that there could be anywhere from 300 to 500 paper ounces for every one physical ounce. And this isn't just gold or Bitcoin. This is anything that uses a ledger. So there's a famous case of Dole, the pineapple company, publicly traded company. And they went through some shareholder things. They were trying to change the organization of the company. And they found out that there was 30% more shares of Dole than had been issued. So when you start trusting people with the ledger, things get off. So back to the question of paper Bitcoin. Once we start adding derivative products on top of Bitcoin, futures, which started in 2017, and then we start having exchanges. So we found out like with FTX, for example, when FTX collapsed, they said they had billions of dollars of Bitcoin. And I believe they only had 2 when they collapsed. So there were paper Bitcoin at FTX, right? People thought they owned Bitcoin when they looked at their account. They owned it, but there was no Bitcoin there. Now, when you talk about lending kind of creates paper Bitcoin because of what's called rehypothecation. So the way rehypothecation works, just for everybody to follow along, is that I lend it to you, but you lend it to somebody else. And what happens is, let's just say that I have a candy bar and I don't need the candy bar right now, but you're really hungry. So I give it to you and you owe me a candy bar, right? So technically on my balance sheet, I have one because you owe me one, and then you actually have one in your hand, but then you loan it to somebody else and loan it to somebody else and loan it to somebody else. So now on paper, 5 of us say we own a candy bar, but in reality, there's only one candy bar. And when that 5th guy decides to eat it, 5 candy bars just disappeared out of thin air because one was taken out. And so that's kind of what happened when FTX and Celsius and all of that collapsed, is all of that rehypothecated, which to your point is this paper Bitcoin that kind of got built up in the system, created the systemic risk. Now, it works both ways. So like obviously in that example, it created that risk where if something happens at one location, it takes everybody else down. But what it also does is it changes the supply demand metrics of Bitcoin, right? So economics 101, price moves on supply and demand. And so if I'm creating artificial supply, it doesn't move the demand properly. So that's sort of the problem with, well, there's a bunch of problems with it. And so, we don't really know. But right now, the amount of options that are happening on Bitcoin and the amount of derivatives that are happening on Bitcoin, and obviously now with the publicly traded companies and the rehypothecation, it's been somewhat cleaned up. I don't have an honest answer of how much that's actually affecting Bitcoin's price. Yeah. We can easily see, and you can just easily understand that I might have bought one Bitcoin, but now I'll use that same amount of money to buy a Bitcoin treasury company. But that Bitcoin treasury company might not buy one Bitcoin. They might buy half a Bitcoin. So now the one Bitcoin I would have taken off the market only got half a Bitcoin taken off the market, for example. So we do know it's impacting the market, but I haven't really seen any good metrics that actually give us that. So we can understand that there's danger there. But then we go back to just like overall lending. Just last week, I was out in New York for the Bitcoin Treasuries Unconference.
Oh, you were there? Nice.
Hosted by Tim Kotzman. It was really cool. And I got to be on the stage with Michael Saylor, and we kind of talked about what the future of finance is with these Bitcoin treasury companies. And I laid out what I call the Rails framework. So we talk about Bitcoin running on Bitcoin Rails, and I laid out the Rails framework. And I think about, a lot of Bitcoiners think that Bitcoin gets rid of financialization, right? So our entire economy has been financialized. Every asset's been securitized and financialized. And we have this whole Wall Street complex that's been built up for mainly the only reason is that our money's broken. And because our money is losing value so fast, we're forced to become investors. And so there's this entire Wall Street complex that's been built up around investors and financial advisors and ETFs and all these things, just so I have a place to put my money. So hopefully it can outpace inflation. So I think Bitcoin takes away most of that. So I think a lot of what Wall Street is there for, a lot of that scaffolding gets compressed, but there's a lot of it that will never go away. Bitcoin will still continue to run on these rails, and the rails, it's an acronym. So R is there's always going to be reserves and savings. So there's always going to be people that there's creators and consumers, and there's creators that are going to create more than they consume, and they're going to save it. Now, of course, with Bitcoin, we can just put it into cold storage. We don't need anyone to help us save it. That's not really how it's going to work. In a future state, at some point, we understand not only is there a scarce asset of only 21 million Bitcoin, but the block space is also limited. Yep. There is not enough block space for 8 billion people in the world to transact on the base layer. Not everybody will be able to transact on the base layer. So we're going to need institutions, financial institutions that can do custody, that have trusts, and that can store it. And not only that, for an individual, not every individual can transact on the base layer, but what if I'm a corporation? What if I'm a public entity? I can't know the 12 words in my head for an entire corporation, for a trust, things like that. And so then for that, you need higher levels of security, multi-sig, things like that. Yeah. And so there's always going to be a need for savings and institutions around that. Okay, then there's A. So this is like allocations and credit. And so to the point that we just asked about credit never goes away. As a matter of fact, credit is the oldest form of money. Before money, there was credit. So like we're both in the same village and like, hey, you need a little bit of the wheat. Okay, here's a little bit of wheat. Get me back next year when your crops grow, right? So that's the oldest form of money. And so we're always going to need to have a need for credit. Entrepreneurs are always going to need funding to start businesses. Entrepreneurs are going to need money to scale businesses, right? Yeah. And savers are always going to look to deploy some of that savings. That will never go away. Like I said, it was the oldest form of money. So that's the A. Then we have the I. Now, I stands for insurance and risk. And so one of the biggest pieces of a financial portfolio for everybody, including personal and institutions, is insurance, right? We don't want to have a catastrophic loss that we can't afford. And so we need insurance. So there's always going to be people that are going to want to offset that risk to somebody else. And there's always going to be somebody willing to underwrite that risk for a fee. So insurance doesn't go away. I think this maybe is one of the most exciting areas for like a Bitcoin treasury company to get into. If you can write risk properly, you can make a lot of money because you get the float, like Warren Buffett famously did with his insurance companies. You get the float, you can put that into Bitcoin. And then that Bitcoin grows in value. So then when you get paid out, you're getting paid out on money that's not being debased, that's holding its purchasing power. So insurance, financial products, and institutions never go away. Then we have the L. And this one, a lot of Bitcoiners don't understand this either. This is the liquidity and payments. And so again, Bitcoin white paper, peer-to-peer electronic cash. So what do I need a financial institution? Why do I need an intermediary? I can just transact peer-to-peer. It says it right in the white paper. And you're absolutely right. You and I can transact right now, lightning fast, over lightning, no pun intended, peer-to-peer. And that's cool. But like, think about it like electricity. I can have a generator in my backyard, or I could just plug into the grid. Now I have a house down in Mexico that's completely off grid. So there's no grid to plug into, and I have solar panels. And that's great. So individually, we can do it peer-to-peer. But like, what about in New York City, where I just was last week? Those skyscrapers, they can't get enough solar panels on there. What about factories? What about cities, right? And so what if I'm Walmart and I have 10,000 locations globally and I'm doing $680 billion of transactions a year? I'm going to do every single one of those one-to-one peer-to-peer? Like, of course not. What if I have 100,000 employees I have to make payroll on? Every single one at a time, I'm going to pay peer-to-peer, right? So like, we're still going to need liquidity. We're still going to need payment providers. There will still always be a need for financial services around that. And then finally, the S. The S is securities and markets. There will always be a need for capital formation. So before equities, about 430 years ago, the equities were created, stocks, and that was created by the Dutch East India traders. But before that, people pooled capital for people to go sell to the New World and bring back riches. So rich people pooled money. Let's all go in and we'll divvy up what they bring back, right? And so there's always going to be a need for capital formation and for price discovery. That's never going to go away. And so there's always going to need to be markets. And so the financial institutions will be, some sort of exchanges and brokerages and things like that. So most of the Wall Street scaffolding goes away because we don't need to invest to keep ahead of inflation. But all of the financial services are always going to be there, but they'll be based on a Bitcoin standard instead of a fiat standard.